Hello everyone, welcome back to yet another video on income tax. And today let's have a walkthrough to understand what exactly is the impact on income tax due to the removal of dividend distribution taxes. And this video is extremely important for those who have invested in equity shares in India, as well as for students who are pursuing their careers in CA or CMA, final or inter from May or June 2021 examination onwards, and for professional colleagues who are in CA or CMA. So at the end of this video, I will give you a complete analysis by way of a flow chart to understand what exactly is the impact of this new insertion. So let's dig it out. Removal of dividend distribution tax and taxing the dividend in the hands of shareholder is known as classical system of taxing, and this is applicable from assessment year 2021-22 onwards. That means from the year 2020-21. So before moving on to the new scheme of taxes, let's understand what exactly is the existing scheme of taxes. And under existing scheme of taxes, a domestic company while declaring dividend, they are supposed to pay dividend distribution tax under section 115O at the rate of 15%. And a shareholder while receiving the dividend can enjoy an exemption under section 1034. And there is another set of tax under 115 BBDA. It says that if the shareholder is in receipt of dividend which is more than 10 lakhs in a year, then the excess of 10 lakhs is subjected to a tax at 10% under section 115 BBDA. This exactly is the existing system. And as a part of our annual budget 2020, government has made certain changes in this existing system. Starting with, they have revoked 115O, that means the dividend distribution taxes. They have revoked 115 BBDA, that is over and above 10 lakh taxation in the hands of shareholders. And they have revoked exemption under section 1034 as well. So, and they have inserted a new section under 80M for giving out a deduction for domestic companies who is in receipt of dividend. And again, they have made amendments under section 57 and amendments under 194, 195 and 115A as well. Now let's go in detail what exactly are these new insertions. First of all, we will discuss from the point of view of a shareholder. So the impact on shareholder who's in receipt of dividend, it says that if the shareholder is a resident in India, then that dividend received will be subjected to tax under IFOS, and the rate of taxes will be at normal slab rate applicable for that recipient shareholder. And at the time of computing taxes, he can take a deduction under 57 for the interest amount suffered by him. Only for the interest amount. And they are also saying the maximum amount of deduction for that interest amount is at 20% of the gross dividend. For example, in a year, I'm in receipt of say 1 lakh rupees as what? Dividend. And I've taken a loan and I'm paying 50,000 rupees as interest. So while computing taxes for this 1 lakh dividend received, the maximum amount of deduction which I can take is 20% of the gross dividend. That's what they're saying. Even though I've paid 50,000 as interest, my maximum deduction for interest will be 20,000 rupees. That is 20% on this 1 lakh. So this is what they have introduced under 57. And if the shareholder is a non-resident in India, then the dividend will be taxable under section 115A at the rate of 20%. And while computing taxes, they are not supposed to take any deduction. That means this 20% is a flat rate of taxes. So this is the impact of a shareholder who is in receipt of dividend. Now, let's understand the impact of the company who pays the dividend. Currently, after the new insertion, there is no dividend distribution tax. But the company who declares or pays dividend is supposed to deduct TDS. That is, there is a tax deduction. So, let's understand what exactly is the tax deduction. This deduction is guided either under 194 or under section 195, depends upon the residential status of the person, that means the shareholder. That means if the shareholder is a resident, then the TDS is applicable under section 194, and if the shareholder is a non-resident, then the TDS is guided under section 195. Now let's understand what exactly is this 194. That means a shareholder, if he is a resident, then what exactly is this TDS guidelines? Starting with the time of deduction. The company is supposed to deduct TDS at the time of paying the dividend. That's what the 194 section says about. And what is the rate? Rate is at 10%. However, as a part of this COVID relief measure, all the TDS rates, there is a discount of 25%. That means even though the original rate is 10%, currently till 31st March 2021, the applicable rate will be 7.5%. That means a 25% discount on all TDS applicable rates. And there is a relaxation as well if the shareholder is an individual and the mode of payment is other than cash, and the aggregate of the dividend paid by such company does not exceed 5,000 rupees, then 194 TDS is not required. That means the recipient shareholder, if he is an individual and the mode of payment is other than what? Other than cash, and the total amount of dividend that the company is paying in a financial year to an individual shareholder does not exceed 5,000 rupees, then 194 TDS deduction is not required. And again, if the shareholder is a non-resident, then the TDS is applicable under section 195. It says the deduction either at the time of payment or credit, whichever is earlier, under 195. And look at the rate. The rate, they say it is at applicable rates. And what is this applicable rate? Applicable rate simply means what exactly is the impact or the tax amount for that recipient non-resident. On that amount, that means on that full rate of tax, or that full amount of taxes, the company is supposed to deduct TDS. This is what is called the applicable rate. That means all the taxes payable by the recipient non-resident shareholder, all that tax have to be deducted as TDS while paying that particular dividend by the domestic company. That is what is TDS rate under 195. Now again, if the recipient is another domestic company, that means if the dividend is received by another domestic company, then the recipient domestic company can take a deduction under 80M for the dividend received. For example, say D1 is a domestic company, they are declaring dividend, and D2 is another domestic company who is in receipt of this dividend. So this D2 can take a deduction for the dividend received from this D1 under section 80M, and this 80M is for avoiding that cascading effect on this dividend taxes. Okay, again moving forward, now let's conclude or summarize this entire scheme of taxes. Okay, starting with a domestic company, while paying or declaring dividend, they have to deduct tax at source either under 194 or under 195. If it is under 194, then the rate is at 10%, and currently it is 7.5%. And if it is under 195, then the rate is applicable rates. And the shareholder who is in receipt of this dividend, then how the taxes depends upon the residential status of that individual shareholder. Okay, if he is a resident, then will be taxed under 56, and he can take a deduction under 57. If he is a non-resident, then the taxation is under 115A. Flat 20% is the rate of taxes, and this exactly is the new scheme for taxing dividend. And that's all for today. Thank you for watching my video. For further queries, you can feel free to contact us on this email or mobile. So see you on next Sunday with yet another video on direct tax. Take care and bye-bye.